Going to talk long term with Michael Zuzolo. JP Morgan is predicting $150 a barrel for crude oil in 2023. We're going to talk about this aspect and several other aspects in this inflation economy. On Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. So, Mike, as I said in the introduction, I would like to talk about the long term today. As the Fed chair said, we don't have transitory inflation anymore. And also, JP Morgan, a very recognized institution, is predicting $150 per barrel of crude oil in 2023. What do you think of those things as we are getting used to more inflation in the US?
Yeah, I found it very interesting that you had told me about that because I had not heard about that, Luis. And I find it really interesting that they jumped from 2022 over to 2023. And so analytically, I'm puzzled by that number, unless you're talking about trying to price fossil fuels high enough to make green energy work with some government subsidy. That's about the only avenue I can see right now for having that high of crude oil price. And the reason I say that is because of 2022. We've got a year coming up here in just about a month that's going to be dealing with the possibility of China slowing down pretty dramatically in their economy. And I'm right around a 5% GDP growth in China for 2022. But there are others that are below 5%. And you start getting below 5%, you're going to see substantial layoffs and unemployment. And you're going to see that economic engine really stall out from a standpoint of the biggest, importer of crude oil and demand for energies, including diesel and unleaded gasoline as well. So I'm skeptical about that and kind of try to wrap it into what we're dealing with right now, staying on the same mindset with 2022. We've kind of got our new two black swans just came in this week, and I think they really can probably dictate a lot of the 2022 trend, along with the third factor, which is China, which is kind of more of an unknown known or a known unknown. We know China's out there, like I just talked about, it could slow down pretty dramatically. But when you think about the Omicron variant of COVID, it really goes to the lockdown mindset of governments and the lack of demand. And so your real economic demand, the more you lock down, especially in Asia, investors and in the real economy, the commodity market's probably going to assume that you're going to have some demand issues as we get into 2022. And the second factor that's more of a black swan that just came out, and you just hinted on it, was not just that the Fed talked about transitory inflation going away in terms of their rhetoric and how they describe inflation, but that not only is it going away, but they're going to turn into much more inflation fighters, and they're going to put on the helmets to bring in a faster pace of tapering their asset purchases. And the market is now going ahead and thinking that the interest rate hikes will happen by the middle of next year. And it was just a day before the Fed talked that the Omicron variant came out, and the interest rate market and the dollar market were thinking, oh, the Fed doesn't have to work as hard to fight inflation because all of a sudden you've got this new variant that could slow down the world economy, especially in Asia. So we got to keep in mind as we go through this next 30 to 45 days, maybe 60 days, that anything associated with the Asia, China, Beijing Olympics, tighter COVID restrictions is going to be associated with demand, and it's going to be associated with emerging market demand and therefore commodity demand. So I'll leave it at that right now.
But do you think that they are working on a scenario that They are considering more supply chain issues.
Yeah, this is a really key point. I'm really glad you brought this up because the two things that I've talked about are only demand related. They are not supply related in the market's mind right now. But you still have weather in South America. You still have weather in the hard red wheat belt of the United States. You still have flooding in Australia. You still have the potential for tighter lockdowns messing up the supply chain and hurting the supply side of the market with this Omicron variant as well. And so, what I've been talking to clients and subscribers about this week is look, we can't just measure the price and the trend on one side of the market. We can't just look at the demand side. We got to get that market to join back up and look at both demand and supply again. Then we can make better. I can make a better recommendation. You can make a better determination of that recommendation and your profitability as we head into 2022. I think it's really, really crucial at this stage of the game, Luis, that we keep in mind, very sincerely and keep it at the very top of our list, the idea that um, the recent break to the downside here may have brought back demand. The recent break in the price action may have done enough to get end users to come into this market. And we see this with talk about Saudi Arabia looking at over 500,000 tons of, I think it was bread quality or high quality wheat, just boom, it just happened overnight on Wednesday night, Thursday morning. And so this is a crucial time that if that's the case, if we've gone low enough to meet demand, then we shouldn't need to take out these recent lows. And so these recent lows are extremely important for me in my analysis. And specifically, it's CCW, crude, copper, and wheat. If we don't take out those recent lows in crude, copper, and wheat, then we can have a retracement and a move back up to, because I think the market will come back together and join demand and supply together. But if we take those lows out that we just put in this week, I would be very nervous and I would go ahead and get some hedges in place because I would assume that the dollar is going on higher and we've got that demand issue and the fear about the emerging markets and the commodities.
And my assumption is that the labor shortage in the United States can worsen as the Biden administration today announced that there will be massive testing as the United Kingdom did previously in the year. But I guess with massive testing and several variants spreading, there will be less workers in the economy.
Yes, and they will stay and remain out of the workplace. And I found out also today on Thursday that Germany is now looking to develop legislation to go ahead and force mandates in their country and looking at a target date of January 1 all across the country of Germany. I mean, you're talking about the largest European economy, largest economy in Europe is Germany. And so you're talking about the impact potential of what does the German workforce do? How does it react? And so this is why I put so much into these lows that we just made and the idea that we could have made a low now that has attracted demand again because of the supply side issues, especially the weather issues, and especially what you rightfully bring up, the supply chain issues that will keep supplies not available to the end users. And they continue to buy extra and hoard essentially so that they don't have to worry about running out.
And in your opinion, what happened in today's session that soybeans jumped 2 digits along with wheat over corn? That corn had was slightly jumping less than the other commodities.
Yeah, this is where it's interesting you bring this up because that is how it looks uh, on the screen. But if you, and I think to answer your question, the Saudi Arabian tender, as well as Turkey looking at more needs for wheat, brought the wheat bull back in. And we're not looking any wetter than we were a week ago here in the hard red wheat belt. We're still looking very dry all the way through mid to late December. The other thing that's gotten traction that brings in the soybeans is the La Nina. I think the La Nina bull is trying to stand again and make a stand in the market saying, look, Argentina's pampas region and the southern Brazil areas, especially Mato Grosso do Sul, Rio Grande do Sul, Paraná, these areas, they're not going to get any rains. And I think the La Nina Bowl is trying to set a marker here and say this market's got to go up because we priced in too big of a crop. Be that as it may, look at what the December corn for 2021 did this afternoon on the close. It went premium to the March. It's now premium in delivery to the March contract. And that is an extremely strong indicator that we have either too much demand or too little supply in the corn market. So these many months that you and I have been talking about, corn being the strongest suit of cards, it has the least amount of downside, it has potentially the most amount of upside because of its own supply demand fundamentals. We made, I think, some gains in that mindset, and that analysis was supported by how we closed in the structure of that market today. The market is now telling the corn trader and the corn hedger and the corn producer, I want your corn more now than I do in 2 months because I'm not going to pay you for it in 2 months. I'll pay you for it right now. So really interesting that this is happening as we go in delivery now for the D's 21 future. So pay attention to what happens this next week and a half.
And do you think that this wheat rally will continue for a while? Because we are having a very different picture compared to 5 years ago when wheat was close to $3 a bushel.
Yeah, you bring up a really good point because Australia's government came out with a very big wheat estimate early this week, and it had even factored in the New South Wales flooding and said it really didn't do much damage to the production potential. It's going to be more about quality. So between that and the hard red wheat belt here in my part of the country or west of me, I'm really still in corn and bean country because I'm right on the Missouri Kansas border. But between the weather in Kansas, Oklahoma, and Texas in southern Nebraska, and what the Australian Bears did this week, I think it makes more sense that if the wheat's going to go higher, it needs to be led by either the spring wheat because it's a protein game here. We don't have enough protein wheat in this world right now. So either spring wheat or hard red wheat needs to be the leader of the upside. I don't like the idea that soft red wheat is leading unless we also see a dollar that's breaking technically and we see the Brazilian currency and the Chinese currency strengthen substantially as the dollar goes down. So I don't like soft red wheat leading unless the dollar is going down, because if that's the case, then the funds are coming in and probably buying the soft red wheat, and that's okay with me. But I'd rather have the hard red and the spring lead this market. That gives me better support, supply demand wise.
And are you betting on worsening conditions in the Brazilian soybean crop? We have seen that that has been the case in the southern parts of the country.
Yeah, I would say it this way, Luis. I think we've got the top end numbers already, not priced in, but already being thrown out there at 146 plus million tons for soybean production. I think it's going to be extremely difficult to get that given our weather pattern right now. If that weather pattern continues into January and February, I've talked to you a lot. You have helped me a lot with the South American side of the equation. It's really January and February that means the most to me as far as production potential, because that's where we really make or break the beans and the pods and the corn and the second crop corn especially. So, but I do think that whatever the one, I think a 110 corn crop is being talked about, and the 146 plus bean crop, those are too high in my opinion. So I think we've seen the biggest numbers as far as what we'll actually see come 3, 4 months from now.
All right, Mike. Thank you so much.
Thanks, Louise. Have a nice week, sir.